Hey guys. All content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. Today was an awful day for stocks, and an even worse one for meme stocks. Now, I should clarify that nothing changed in regards to us buying and holding or MOIS, but rather, we have now begun to see the far extent by which big Wall Street money is willing to go at this moment in order to socialize the pain and punishment of their own decisions. I have one question for you. What does big money do when trapped in an unescapable short position of their own design? Do they apologize and start covering as they can? Absolutely not. The mind of psychopaths are biologically unable to admit a mistake, much less learn from it by fixing it. In order to understand how sickening the greed and unimaginable power that these institutions have, big money has architected their new weapon, an ETF called REX. Through this new abortion of an ETF, the institutions hope to share the liability of their short positions with retail. You see, they will package these baskets with certain securities to make them appealing for buyers and get good scores. They will leverage people's hard-earned retirements, for example, in order to redistribute the massive losses they will realize once they cannot kick the can any further. But again, the real disappointment doesn't lie with Wall Street's clever ways to make up things in order to avoid a colossal fallout. Instead, who is here to blame is the SEC, who once again has implemented changes that allow for such transgressions against retail to happen in the first place. Because this is an ETF that shorts GameStop and AMC among other popular stocks, this ETF does not even require the approval of the SEC. That's right, through an exemptive order, the SEC built the framework to change the criteria needed for an ETF to come directly to the markets without first obtaining permission. What was the cherry on top of this was the fact that we had brokers such as TD Ameritrade marketing and advertising this REX ETF. They are trying to get people into it, and with companies like Benzinga also promoting the ETF on their main page, who knows what effect this could have. Now, this doesn't change anything about the short positions hedge funds and banks are stuck in, but the price action will be affected by it on the day-to-day. The way the SEC, the corporate media and institutions all collaborate to further the perils of retail investors' ability to make money is beyond repugnant, and my conviction in meme stocks has only been strengthened by it. Now, let's talk a bit broader about the overall economy, because things are starting to get really dire in ways that it's not even being reported by the media. First of all, let's talk about energy. Reports are coming out that in the United Kingdom, thousands of pubs face closure without urgent government support. Energy bills across the UK are due to rise more than fivefold in some cases, and almost half of UK's 47,000 pubs said their tenants were already giving notice. This is a huge deal, because if tenants are unable to pay their rent, it means business will close. If businesses start shutting down en masse, we could see further acceleration of deterioration in the economy, which could lead to a huge economic fallout alike that of 2008. Yes, this is all happening in Europe, but as we hopefully have learned by now, what happens over there matters over here as well. Do not think for a second that the United States will be isolated from this disastrous potential catastrophe. Furthermore, Europeans are now having to adapt to taking cold showers as officers are turning down thermostats and stores are dimming lights in order to avoid blackouts. With everything happening in Russia, countries in the European Union are having to make serious adjustments to everyday living circumstances in order to survive. The situation is very dangerous economically speaking, because this could affect businesses as we know them, and as we know, stocks are very reactive and sensitive to quick changes. Given the major retracements we have recently endured and the overall weakened sentiment of the market, a big enough change in the economy of Europe as a whole will have direct ramifications for ours, where we could see the value of securities all across the board fall down significantly. We have also seen Europe's electricity prices hit record highs as Russian supply cuts begin to bite. And this leads me to my main point that I have been wanting to bring up. We are at a point where I think a recession is simply unavoidable. The areas of the economy that are positive are limited, and the risk and further regression of economic output simply makes me believe we will not be reaching new highs in a very, very long time. These changes in the energy sector are incredibly dangerous, and as an investor, you need to look at this more than anything else in order to anticipate future market behavior more right than wrong. I didn't make a video on Friday because I was digesting all the things Jerome Powell had to say. After taking a couple of days to think about what was said, to see the response from the population and read interesting editorials about it, I can confidently say that for the first time since I began making videos, I think Jerome Powell did something good. Let's wind the clocks back just a week ago. Stocks were going up. People were calling the bottom as a thing of the past, that the economy is just too strong and that we were bound for strong upward movement if Jerome made the statements people wanted to hear. Well, in a shocking state of events, Jerome Powell did say exactly what he has been saying, keeping tact with his previous statements and perceptions of what the Fed might do. But the key note here was the way in which he said things. He didn't cookie-cutter things just so that investors can feel good about nothing. He said things direct and as they are, and investors' bullish sentiments disappeared faster than my blind dates. Again, don't even take it from me. When determining what to do, you should always observe how smart money is acting. What things are they saying? We take a look at billionaire investor Charlie Munger, arguably Warren Buffett's closest partner at Berkshire Hathaway. He recently had an interview with Daily Journals and he said, and I quote, "What we are getting is wretched excess and danger for the country. Everybody loves it because it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. Eventually, there will be considerable trouble because of the wretched excess. That's the way it's usually worked in the past." Though Charlie Munger has his controversial opinions about GameStop and Bitcoin, I do not think we should immediately pass off anything he says as unworthy of attention, for the man is a much better investor than all of us combined. The connections he has and wealth of knowledge of markets is paramount, and I doubt he has had the interest to really look into GameStop as a whole in the first place before he formed that opinion about it. The point is, he made some statements that reflect how other investors and big money might feel about the current economy, which is that it is overly valuated to the point where it is due a reality check. Wretched excess has been a symptom of poor economic policy fostered and pushed for decades, and the result has been a market bubble. Because of this, we must now discuss the implications that this might have on the economy as a whole, for nothing is certain and I can see many ends to all of this. First are that going forward, we see disappointing or lackluster returns. We have already seen economic growth outlook be pointed as weak. Furthermore, after the Jerome Powell statements, it is without a doubt that we will likely have higher interest rates in the future. When you combine weak growth, low dividend yields and higher interest rates, you get a stock market with mediocre returns, which means the road ahead will be slopping even further down with small brief periods of market retardation where you see the great psychological phenomenon of bulls getting overly optimistic until reality slaps them across the face. Another implication we might see is the deterioration of Europe and China markets. We spoke about China at length in great detail last week, so you know the situation is boiling hot over there, and now we are seeing Europe literally force themselves into worsening living conditions as they try to adapt to changes brought about by the high energy costs. And lastly, and this is the famous one, we see a huge market crash. That's right, a market crash is still on the table and very, very possible under these current circumstances. What could offset this? Well, further deterioration of the economies at the current or advanced pace at which they go. We have seen news of Chinese getting really hostile with Taiwan, and any invasion into the country will most certainly send everything crashing down in the world. A new pandemic, which now seems to be happening almost every year. These things would be asking to quick unpredictable events that would upset the market. Remember, markets are very sensitive to quick changes, and when things get shaky, stocks contract until things are priced out. With uncertain events such as this pressing down, it would be like a meteor hitting Earth. We are not prepared for an event like this, much less withstand it, and we go into a recession immediately. Even the White House will have problems making a new definition for it at that point. And amidst all of this, I do still think that the best stocks to save my money are in AMC and GameStop. I will continue to use these two or my own personal savings piggy bank. The media can hate me, disenfranchise me and mock me all they want. I will continue buying more, even if I am the last person on earth to do so. Dark pool trades reported for AMC have accounted for 47% of the total volume today, while dark pool trades reported for GME have accounted for 40% of the total volume. Lastly, I was asked about the tweet I made yesterday with CNBC quickly cutting off their guest as soon as she mentioned shorts covering. They made a whole segment about it today, explaining how it was due to some technical difficulties. I just find it interesting how something always happens when the topic at hand relates to GameStop or AMC. The corporate media in the United States has never been so malignant and focused in misinforming its audience, so I beg of you all to always think on your feet and never take their words as gospel. They are coming at us retail investors from all angles, and we need to be on our feet and ready at all time. This was all I had for you today. Sorry for the delay of the video. Guys, I am making a ton of money day trading, and I am sharing my plays on Discord. If you follow me on Twitter, you must have seen the magnificent profits I brought, and I want to share the glory with you. Come check them out. Link for the Discord is in this video's description. Let me know what you thought of the video. I hope to see you tomorrow. Enjoy the rest of your day and to the moon.